While the world sleeps, while official markets remain frozen at 76.20, there exists another market, a shadow exchange operating beyond regulatory reach, where silver is changing hands at $88 per ounce, an $11 or an 80 in chasm between what screens display and what transactions reveal. This is not a glitch. This is not speculation. This is capital in motion, bypassing official channels, signaling something the establishment does not want measured. By Monday morning, one of two things will happen. Either this gap vanishes, erasing billions in implied value, or it widens, confirming that the official price has become irrelevant. What happens next will redefine how precious metals are valued. The question is not whether you believe the spread. The question is, do you understand what it means before markets open? Welcome to Market X-Ray, where we examine what financial headlines deliberately overlook. If you have been navigating markets for decades, if you remember when price discovery actually functioned, when settlement meant delivery, not promises, then you understand why this channel exists. We ask you, the seasoned observer, the strategic thinker, to subscribe, not for entertainment, but for analysis the mainstream will not provide. And tell us, from which corner of the world are you watching this unfold? London, Singapore, New York, Dubai? Because capital flows know no borders, and neither does this analysis. Now, let us dissect exactly what this weekend gap reveals. On February 7th, 2026, at precisely 5 p.m. Eastern Standard Time, the COMEX silver market closed its weekly trading session. The final settlement price registered at $76.20 per ounce. Trading terminals across New York went dark, order books froze, and the official mechanism for determining silver's value entered its scheduled weekend suspension. For most observers, this appeared entirely routine, but within hours, something extraordinary began unfolding in markets that never sleep. By Saturday morning, silver was changing hands at $88 per ounce in gray market transactions, an $11.80 premium over the official closing price. This was not a minor deviation, not a rounding error, not a temporary blip in overseas trading. This was a structural dislocation revealing fractures in how precious metals are priced, traded, and valued in global markets. The gray market, comprised of international dealers, private transaction networks, and exchanges operating outside COMEX jurisdiction, was broadcasting a message the official system could not transmit. Demand had not paused when COMEX closed, it had intensified, and that demand was willing to pay nearly 16% above the official price, simply to acquire physical silver during the weekend void. To understand the significance of this spread, one must first understand what happens during weekend market closures. The COMEX, the primary venue for North American precious metals price discovery, operates on a traditional exchange schedule, Monday through Friday, with specific trading hours that end each Friday afternoon. When those hours conclude, the official spot price freezes, remaining static until markets reopen Sunday evening. But the global economy does not operate on a 5-day schedule. Manufacturing facilities in Asia continue production, requiring industrial silver. Jewelry manufacturers in India continue operations, demanding physical metal. Investment funds in the Middle East continue portfolio adjustments, seeking precious metals exposure, and sovereign wealth managers in Singapore continue strategic allocations, accumulating tangible assets. All of this activity generates demand, real demand, backed by actual capital, seeking actual silver, yet the official price, the number displayed on financial websites, on trading platforms, on news tickers, remains unchanged at $76.20. This creates what economists call a price discovery vacuum, the mechanism designed to match buyers and sellers, to reflect supply and demand dynamics, to establish fair market value, has temporarily ceased functioning. But the market itself, the living organism of human exchange, does not cease. It simply migrates to alternative venues. These alternative venues, collectively known as the gray market, include over-the-counter dealer networks, private bullion exchanges, international spot markets in London and Zurich, and physical delivery platforms in Asia. They operate continuously, reflecting real-time transaction prices, adjusting instantly to supply constraints and demand surges. And this weekend, they were reflecting an $88 price point. The $11.80 spread represented more than just a weekend premium. It represented a measurement of market stress, a quantification of the gap between official mechanisms and actual transaction reality. Historical data provides crucial context for evaluating this spread's magnitude. During normal market conditions, weekend premiums in gray markets typically range from $0.50 to $2 per ounce, reflecting modest arbitrage opportunities and minor liquidity adjustments, even during periods of elevated volatility, such as the 2020 pandemic market disruption. Weekend spreads rarely exceeded $5 per ounce. The current $11.80 spread falls into a statistically rare category, comparable only to extreme market stress events. The 2011 debt ceiling crisis, when sovereign default fears drove precious metals demand, produced weekend spreads approaching $9. The 2013 Cyprus banking crisis, when depositor bail-ins triggered capital flight into tangible assets, generated spreads near $7.50. But an 11.80 spread, occurring not during an acute crisis, but during what appears to be routine market conditions, signals something fundamentally different. It suggests the divergence is not event-driven, but structural. Physical silver dealers reported unprecedented demand throughout the weekend. Coin and bar premiums, the markup above spot price that dealers charge for fabricated products, had already been elevated for months. But during this particular weekend, those premiums expanded beyond normal ranges. American Silver Eagles, typically trading at $4 to $6 above spot, were being quoted at $12 to $15 premiums. Canadian Maple Leafs, historically carrying $3 to $5 markups, were commanding $10 to $12 premiums. Even generic silver rounds and bars, the lowest premium products available, were being sold at $8 to $10 above the frozen $76.20 official price. This was not price gouging. This was price discovery happening in real time outside official channels. Industrial buyers faced similar conditions. Electronics manufacturers seeking delivery contracts for Q2 production, solar panel producers securing supply for spring installations, all encountered pricing substantially above the official COMEX settlement. The market was speaking clearly, but the official price remained silent, frozen, disconnected. This disconnect raises a fundamental question that will determine outcomes for investors, manufacturers, and strategic planners alike. When Monday morning arrives, when COMEX reopens, when official price discovery resumes, will the gap close, with gray market prices falling back to official levels, or will it persist, forcing official markets to acknowledge the higher valuation that transaction reality has already established? The answer will reveal whether this weekend's spread represents a temporary arbitrage opportunity, or the beginning of a structural repricing in how silver is valued globally. The mechanics behind this dislocation, the forces driving demand at premium prices, and the strategic implications for market participants, these require deeper examination. The gray market does not exist by accident. It exists because official market architecture, designed decades ago for a different era, cannot accommodate the velocity and geography of modern capital flows. To understand why silver traded at $88 while official screens displayed $76.20, one must first understand the fundamental mismatch between 21st century demand patterns and 20th century exchange infrastructure. The COMEX operates as a centralized exchange, physically located in New York, governed by American regulatory frameworks, constrained by regional trading hours. It opens Monday morning, processes orders throughout the week, and closes Friday evening. This structure made perfect sense in 1975. When the exchange was founded, when international wire transfers took days, when most trading occurred via telephone, when market participants operated within similar time zones, but the world has transformed dramatically since then. Capital now moves at digital speed, crossing borders in milliseconds, responding to events in real time, regardless of which exchange happens to be open. A central bank announcement in Tokyo at 2 nows a.m. New York Time triggers immediate portfolio adjustments globally. A mining production report from Peru released Saturday morning creates instant supply calculations. A monetary policy shift in the European Union during Sunday afternoon generates immediate hedging activity. Yet the official pricing mechanism, the COMEX settlement that everyone references, remains locked at Friday's closing figure throughout these events. This creates what market theorists call temporal arbitrage opportunities, price discrepancies emerging not from information asymmetry, but from timing asymmetry. The gray market fills this temporal void. It operates through a decentralized network of participants, each following their own regulatory environment, each maintaining their own trading hours, collectively creating a continuous marketplace. The London bullion market, operating under UK Financial Conduct Authority oversight, provides price discovery during European business hours. The Shanghai Gold Exchange, functioning within Chinese regulatory frameworks, establishes pricing during Asian trading sessions. Singapore precious metals dealers, Dubai bullion markets, Swiss vaulting facilities, each contributes to continuous price formation. But these are not rogue operations or unregulated Wild West exchanges. They are legitimate market venues, operating under their respective jurisdictions, serving real economic needs that the COMEX schedule cannot accommodate. A Japanese electronics manufacturer needing silver for Monday production cannot wait until Sunday evening when COMEX reopens. They must secure supply immediately through dealers who can deliver at prices reflecting current supply-demand dynamics. An Indian jewelry fabricator receiving a large order. Saturday morning cannot delay procurement until American markets resume. They must transact now, through available channels, at prevailing market rates. A European investment fund executing month-end rebalancing over the weekend cannot postpone precious metals allocation. They must complete transactions within their operational time frame. Regardless of COMEX closure, these participants are not seeking to exploit inefficiencies or game the system. They are simply conducting necessary business in real time, using available market infrastructure. The $80 price point they established represents genuine supply-demand equilibrium for immediate settlement transactions. But there's another dimension to gray market pricing that official exchanges deliberately avoid measuring: the distinction between paper silver and physical silver. On COMEX, the vast majority of contracts are cash settled, meaning no actual metal changes hands. Traders buy and sell contractual obligations, financial derivatives, promises to deliver silver at specified prices. These contracts can be created, traded, and closed without a single ounce of physical metal moving. Estimates suggest that for every ounce of actual silver backing COMEX contracts, there are anywhere from 100 to 250 ounces of paper claims trading. This creates enormous leverage and enormous price efficiency for financial speculation. But it also creates a fundamental disconnect between contract prices and physical availability. The gray market, by contrast, deals almost exclusively in physical transactions or immediately deliverable claims. When a dealer quotes $88 for silver over the weekend, that price reflects actual metal in actual vaults, available for actual delivery. There is no leverage, no paper multiplication, no contractual abstraction, just metal, capital, and settlement. This distinction becomes critical during periods of stress. When participants begin questioning whether paper claims can actually be converted to physical metal, premiums emerge. The $11 8D weekend spread was not merely a time zone arbitrage. It was a physical premium, a scarcity signal, a measurement of how much more buyers must pay to secure actual silver rather than contractual promises. Historical precedent illuminates this pattern clearly. During March 2020, when pandemic lockdowns froze logistics and refineries, physical silver premiums exploded. COMEX contracts traded near $12 per ounce. While physical dealers could not source metal below $18, a $6 premium emerged, not because of price manipulation, but because paper abundance coexisted with physical scarcity. The current weekend spread follows similar logic. Somewhere in the global supply chain, between mines and manufacturers, between refineries and retail dealers, between vaults and end users, physical availability has tightened sufficiently that weekend buyers must pay 16% premiums to secure immediate delivery. This tightness does not appear in official inventory reports. COMEX warehouse stocks show adequate supply. Exchange-traded fund holdings remain stable. Reported dealer inventories appear normal. But these official metrics measure stored metal, metal sitting in vaults, metal not currently in transit toward end users. The gray market measures something different. It measures available metal, metal that can be purchased today, delivered this week, allocated to specific buyers. And that measurement, reflected in the $80 weekend price, tells a story official statistics cannot capture. The story of a market where demand velocity exceeds supply chain responsiveness, where buyers compete for immediate availability rather than waiting for scheduled deliveries, where the price of certainty, the premium for guaranteed possession, has risen to levels that suggest underlying stress. But stress alone does not explain an $11.80 spread. Stress creates volatility, creates temporary premiums, creates short-term dislocations that resolve quickly. Structural change creates persistent divergence. And what unfolded during this particular weekend appeared less like temporary stress and more like the early stages of a repricing driven by forces that will not dissipate when markets reopen Monday, forces rooted in macroeconomic shifts, industrial demand transformation, and capital flow patterns that are accelerating rather than stabilizing. These underlying drivers require examination because they determine whether the weekend gap represents an anomaly or the new normal. Behind every price, there's a story of scarcity. Behind every premium, there's a calculation of risk. And behind the $11.80 weekend gap, there exists a convergence of forces that have been building quietly for months, intersecting suddenly during a moment when official markets could not respond. The gray market price of $88 was not random. It was not speculation. It was the mathematical result of multiple demand streams colliding simultaneously, each driven by distinct motivations, each operating on different time frames, each amplifying the others. To understand why buyers paid 16% premiums for weekend silver, one must trace the capital flows that created this urgency. The first stream originates in central bank policy rooms across the developed world. For nearly 2 years, Monetary authorities maintained restrictive policies, raising interest rates to combat inflation, withdrawing liquidity from financial systems, creating an environment hostile to non-yielding assets like precious metals. But by late 2025, that narrative began fragmenting. Inflation proved more persistent than models predicted. Economic growth began decelerating faster than anticipated, and debt service costs reached levels that threatened fiscal sustainability. Central banks found themselves trapped between conflicting mandates: continue fighting inflation through restriction, risking recession and debt crises, or pivot toward accommodation, accepting persistent inflation as the lesser evil. By February 2026, market participants had reached a consensus. The pivot was inevitable. The only question was timing. Rate cut expectations surged. Quantitative tightening reversal became the baseline scenario, and the prospect of renewed monetary expansion returned to probability calculations. This shift triggered portfolio repositioning on a massive scale. Institutional investors who had abandoned precious metals during the rate hiking cycle began rebuilding positions, not as speculative trades, but as structural allocations against currency debasement risk. And when a pension fund in Norway adjusts its precious metals allocation from 2% to 4%, that represents billions in capital-seeking deployment. When a sovereign wealth fund in Abu Dhabi increases its tangible asset position by even 1 percentage point, that translates to acquisition programs spanning months. These institutions do not trade frantically. They accumulate methodically, but their aggregate demand creates sustained pressure that overwhelms marginal supply. And unlike retail investors who might panic sell during volatility, institutional buyers view price dips as acquisition opportunities. This creates a demand floor, a baseline buying pressure that persists regardless of short-term price movements. The second capital stream flows from industrial users, facing a calculation that has nothing to do with investment thesis. They need silver, physically, for production processes that cannot substitute alternative materials. Solar panel manufacturing, the single largest industrial demand driver, consumes approximately 20% of annual silver production. Each panel requires silver paste for photovoltaic cells, a use case where conductivity and reliability outweigh cost considerations. As global solar installations accelerated through 2025, driven by energy security concerns and decarbonization mandates, silver demand from this sector surged beyond previous forecasts. Chinese manufacturers alone increased silver consumption by 18% year over year. American solar producers, benefiting from domestic content requirements under industrial policy legislation, increased orders for domestically sourced silver by 34%. European fabricators, navigating energy crisis, aftermath, and green transition commitments, expanded silver procurement contracts across all future quarters. But solar represents only one industrial segment. Electronics manufacturing, from smartphones to automotive components to defense systems, requires silver for switches, contacts, and circuit boards. Military applications, from missile guidance systems to electronic warfare equipment, specify silver for reliability in extreme conditions. Medical devices, from antimicrobial coatings to diagnostic equipment, utilize silver's unique properties. Each of these sectors operates with just-in-time inventory models under normal conditions. But 2025 taught supply chain managers a harsh lesson. Just-in-time becomes just too late when supplier networks fracture. The result was a systematic shift toward inventory building, forward purchasing, and supply security at the expense of cost optimization. Manufacturing executives who once ordered silver quarterly began contracting 6 months forward. Procurement departments that previously accepted spot pricing began locking in fixed price agreements. Supply chain officers who historically maintained minimal stockpiles began building strategic reserves. This behavioral shift, from cost minimization to availability assurance, fundamentally altered demand patterns. It transformed silver from a commodity purchased as needed into a strategic input requiring proactive securing. And when these industrial buyers encountered weekend supply constraints, they paid gray market premiums without hesitation. Because the cost of production delays far exceeded any precious metals premium, the third capital stream emerged from geopolitical fragmentation accelerating throughout 2025. Trade tensions that once focused narrowly on technology and manufacturing broadened into resource nationalism. Mining jurisdictions began implementing export restrictions, favoring domestic refiners over international buyers. Peru, the world's second-largest silver producer, introduced legislation requiring minimum domestic processing percentages. Mexico, another major producer, expanded restrictions on raw ore exports, mandating value-added refining within national borders. These policies did not eliminate supply, but they complicated logistics, extended delivery timelines, and created uncertainty around contract fulfillment. Simultaneously, sanctions frameworks expanded to include resource flows. Strategic materials became tools of economic statecraft, subject to restrictions, licensing requirements, and political considerations. This environment transformed procurement from a purely commercial function into a geopolitical navigation exercise. Buyers could no longer assume that contracted supply would arrive as scheduled. They could no longer trust that logistics channels would remain open indefinitely. They could no longer operate under the assumption that markets would always clear efficiently. This uncertainty premium, the additional cost buyers accept to secure supply despite geopolitical risk, began appearing in physical markets throughout 2025. By February 2026, it had become embedded in pricing structures. The weakened gray market premium partially reflected this geopolitical risk calculus. Buyers were not merely purchasing silver, they were purchasing certainty, control, and strategic positioning. These three demand streams, monetary policy repositioning, industrial supply chain transformation, and geopolitical resource security, each would be significant independently. Combined, they created demand density that official market structures struggled to accommodate. The COMEX was designed to handle speculative trading volume, financial contract flows, paper market liquidity. It was not designed to channel the simultaneous physical demands of solar manufacturers, electronics producers, institutional allocators, and strategic buyers all competing for immediate delivery. When these forces converged during a weekend, when official price discovery mechanisms went offline, when only gray market channels remained operational, the result was inevitable. Prices rose to levels necessary to clear available supply. Premiums expanded to reflect actual scarcity rather than paper abundance, and the $88 weekend price emerged as the true market clearing level. But this raises the critical strategic question: were these demand drivers temporary, destined to normalize once markets reopened, or were they persistent, likely to intensify, signaling a fundamental repricing underway? The answer determines whether the weekend gap represented an arbitrage opportunity or a warning. The weekend gap presents decision makers with a deceptively simple question: what happens Monday morning when official markets reopen? But the answer to that question carries implications far beyond a single trading session, because the gap itself, the $11.80 divergence between official settlement and gray market reality, is not merely a pricing anomaly. It is a stress test of market infrastructure, a measurement of structural integrity, a signal revealing whether current pricing mechanisms remain fit for purpose, and how that gap resolves, whether it closes, widens, or persists, will determine strategic positioning for months ahead. There are three primary resolution scenarios, each with distinct characteristics, each requiring different response frameworks. The first scenario involves rapid gap closure through gray market price decline. In this outcome, the $88 weekend price proves to be temporary demand surge, weekend illiquidity premium, or positioning error by gray market participants. When COMEX reopens Sunday evening, official markets establish pricing near Friday's $76.20 close, potentially with modest upward adjustment to $77 or $78. Gray market participants, facing competition from official exchange liquidity, reduce premiums to maintain competitiveness. Physical dealers, seeing spot prices stabilize, lower their markup spreads back toward historical norms. Within 48 hours, the weekend dislocation fades into market history, becoming a footnote about weekend volatility rather than a structural signal. This scenario would suggest that the demand drivers analyzed in Part 3, while real lack sufficient intensity to overcome official market liquidity, it would indicate that institutional buying remains gradual rather than urgent, that industrial supply chains retain adequate flexibility, that geopolitical concerns have not yet translated into panic procurement. For strategic decision makers, this outcome would justify watchful waiting, maintaining current positions, monitoring for genuine supply stress rather than reacting to weekend anomalies. But this scenario requires several assumptions to hold true. It assumes COMEX inventory can satisfy delivery demands at current price levels. It assumes that industrial buyers encountered weekend urgency that will dissipate during normal trading hours. It assumes that the premium reflected illiquidity rather than genuine scarcity. Historical precedent offers mixed guidance on this scenario's probability. Weekend gaps typically do close quickly, within the first trading session following market reopening, but gaps of this magnitude, exceeding $10 per ounce, have rarely occurred outside crisis environments. And when they have occurred, they have rarely closed completely without leaving persistent elevation in base pricing. The second scenario involves gap expansion through official market price elevation. In this outcome, COMEX reopening triggers substantial buying pressure, driving official spot prices upward toward gray market levels. Buyers who waited through the weekend, hoping for better entry points, recognize that gray market pricing reflected genuine supply-demand dynamics. They enter aggressive buy orders at market open, creating momentum that pushes official settlement toward $87 potentially matching or exceeding weekend gray market levels. Physical delivery requests surge as buyers seek to convert paper positions into actual metal. COMEX warehouse inventories begin declining as standing for delivery becomes preferred strategy over cash settlement. Industrial users, observing price momentum, accelerate procurement schedules to lock in current levels before further appreciation. Within days, the weekend gap closes not through gray market decline, but through official market recognition that $76.20 significantly undervalued actual supply-demand equilibrium. This scenario would validate the structural demand drivers outlined previously. It would confirm that monetary policy expectations, industrial supply chain pressures, and geopolitical resource security concerns have fundamentally altered silver's pricing baseline. It would signal that the weekend gray market was not overpricing metal, but that official Friday settlement was underpricing it. For strategic participants, this outcome would require rapid position adjustment. Buyers would need to secure exposure quickly before further appreciation. Sellers would need to reassess whether current inventory should be retained rather than liquidated. Manufacturers would need to accelerate hedging programs and forward purchasing agreements. But this scenario also carries warning signals beyond immediate price implications. If official markets must rise 15% within days to align with physical reality, it suggests paper market pricing has become disconnected from underlying fundamentals. It raises questions about whether COMEX settlement accurately reflects available supply versus contractual claims. It introduces concerns about delivery capacity if large percentages of contract holders simultaneously demand physical settlement. The third scenario, and perhaps most concerning from a systemic perspective, involves persistent gap maintenance. In this outcome, COMEX reopens near Friday's closing level, perhaps rising modestly to $78 or $79. But gray market pricing remains elevated, continuing to trade at $85 to $90 throughout the following week. The spread narrows somewhat from weekend peaks, but persists at $7 to $12 above official settlement. This creates a two-tier market structure, where paper contracts trade at one price level while physical transactions clear at substantially higher levels. Buyers seeking immediate delivery or guaranteed allocation or geographically specific sourcing pay gray market premiums. Buyers willing to accept contract settlement, future delivery dates, or counterparty risk transact at official market prices. The spread becomes a permanent feature rather than temporary anomaly. This scenario represents market fragmentation, the breakdown of unified price discovery, the emergence of distinct pricing regimes for different transaction types. Historical parallels exist in other commodity markets during stress periods. During the 2020 crude oil crisis, physical barrels traded at substantial premiums to futures contracts as storage capacity constraints created delivery complications. During 2021 lumber shortages, cash transaction prices diverged dramatically from futures settlement as supply chain disruptions prevented efficient arbitrage. During 2022 natural gas volatility in Europe, spot prices for immediate delivery bore little relationship to forward curve pricing. In each case, market fragmentation reflected underlying structural problems, supply-demand imbalances that paper markets could not resolve through price adjustment alone. If silver enters similar fragmentation, it signals that current supply cannot satisfy current demand at any price the official system is willing to establish. It suggests that participants trust physical possession over contractual claims. It indicates that the financial market for silver and the physical market for silver have become distinct ecosystems with distinct pricing logic. For decision makers, persistent gap maintenance requires fundamental strategy reassessment. It means that official spot prices no longer reliably indicate acquisition costs for physical metal. It means that hedging strategies based on COMEX contracts may not protect against actual procurement expenses. It means that inventory valuations using spot prices may significantly understate replacement costs. The strategic framework for navigating these scenarios requires monitoring specific indicators that will clarify which outcome is developing. First indicator: COMEX warehouse inventory flows during the week following market reopening. If inventories decline sharply, it confirms physical demand intensity and supports gap expansion or persistence scenarios. If inventories remain stable or increase, it suggests weekend premium was temporary illiquidity rather than genuine scarcity. Second indicator: ETF holdings changes across major silver-backed investment vehicles. If institutional vehicles show net inflows, it validates the monetary policy repositioning thesis and supports higher pricing. If holdings remain flat or decline, it suggests institutional buyers are not yet convinced of structural repricing. Third indicator: refinery delivery schedules and fabricator lead times. If delivery delays extend beyond normal windows, it confirms supply chain stress supporting premium pricing. If fulfillment timelines remain normal, it indicates sufficient supply elasticity to meet demand at current levels. Fourth indicator: industrial user hedging activity, and forward purchase behavior. If manufacturing companies accelerate hedging programs or extend contract durations, it reveals genuine supply security concerns. If procurement patterns remain unchanged, it suggests industrial buyers view weekend pricing as aberration. Fifth indicator, dealer premium spreads on retail products throughout the following weeks. If coin and bar markups remain elevated above historical norms, it confirms persistent physical tightness. If premiums compress back toward $3 to $5 ranges, it indicates weekend stress was temporary. These indicators will not provide certainty, but they will provide probability adjustments. They will allow strategic participants to update their assessments as new information emerges. They will enable informed positioning rather than reactive scrambling. The weekend gap ultimately serves as a case study in market structure evolution. It demonstrates what happens when 20th century pricing infrastructure encounters 21st century capital velocity. It reveals the tension between centralized exchange control and decentralized global demand. It exposes the fragility of price discovery mechanisms that assume continuous market operation, yet implement scheduled closures for the business community, for institutional investors, for manufacturing strategists. The lesson transcends silver specifically. It applies to any market where official pricing mechanisms periodically disconnect from transaction reality, where paper claims multiply beyond physical backing, where global demand operates continuously while exchanges maintain regional schedules, where geopolitical fragmentation creates parallel markets that official systems cannot integrate. The $11.80 weekend gap may close by Tuesday, or it may widen by Wednesday, or it may persist for months as a new structural feature. But regardless of immediate resolution, it has already delivered its message. The message that markets are evolving faster than the infrastructure designed to measure them, that price discovery is migrating toward venues that can operate continuously, globally, with physical settlement certainty, that the gap between what official systems report and what transactions reveal is widening, and that strategic positioning requires monitoring both simultaneously. Because in modern markets, the official price tells you what the system wants you to believe, but the gray market price tells you what participants are willing to pay. And understanding the difference is the difference between reacting to events and anticipating them. The weekend is over. Markets will reopen. The gap will resolve one way or another. But the structural forces that created it remain in motion.